selling investments for liquidity sounds logical until you realize it could break long-term compounding. Whenever investors need quick liquidity, the instinct is simple: redeem mutual funds, right? But with product like loan against securities gaining traction, the real question is, should you exit your investments or borrow against them? Tonight, we decode which option truly makes financial sense. And to decode exactly this, we're joined by Nikhil Kothari, who's the director of Etica Wealth Private Limited, joining us now. Nikhil, thank you so much for taking out the time and speaking with us at NDTV Profit. My first question to you is that generally, when investors are looking for liquidity, the default reaction is to either redeem mutual funds. But do you think that this is, always the smartest exit to make?
See, always first we need to realize that what is the purpose of this redemption, right? Is the purpose for really long term? If it's a goal, like if you're invested for a goal and your goal is achieved now, and you need money for that purpose, then it's obviously wise to withdraw the money because your goal is already achieved. But if it's not because of that, and you need some money for your bridge funding, say for example, suddenly you have a delayed in the salary or delayed of some payments, and you need to do a bridge funding, then it's not a wise call to withdraw your long-term assets to pay for those goals or those bridge funding, because you are breaking long-term compounding. So you need to understand the purpose of withdrawal. If the purpose of withdrawal is very, very short-term, is to bridge a funding which is for say 1 month, 2 months, or 6 months, then it's wise to take a loan against mutual funds or loan against securities. But if the purpose is like say really long term, like say for example you're buying a house and you want to make a down payment, right? Or your kid is going for education and you need to pay a school fees or pay a payment or college fees, then it is advisable to withdraw because that is long term in nature and you're not going to get this money back. But if the purpose is very, very short term, then it's always advisable to take loan against securities, because you're not breaking the compounding, right? And you're not paying huge capital gain tax also.
Sense. And when we talk about loan against securities, it's often sold as don't disturb your investment solution. But is this a real trade-off that you always look at?
See, basically, earlier, when you had to apply for loan against securities, it was a very, very cumbersome process. But now with the whole advent of online and the technology, right, we can get a loan against securities very, very seamlessly. So the liquidity is very, very high. Now, why this pitch is again from a perspective that if you need money for overdraft facilities or you need money in terms of bridge funding, say for example, you have got a 1 crore rupees. Now, you may need this money for sometimes for 5 days, sometimes for 10 days, sometimes for 15 days. Then every time withdrawing this money doesn't make sense. So it's advisable that you invest this money, and whenever you need this money for short-term needs, right, like the bridge funding, that time you again always take this loan against securities and use this money as a overdraft facility. And as soon as your work is done, you can repay that, and you only pay interest for that tenure which you have taken the loan. So if the pitching is very clear that if the money is not required for long term and money is required for very, very short term, unnecessarily breaking the long term assets, right, is not advisable, and you are losing out on compounding benefit and you're paying huge amount of taxes, right? And so it's always advisable for very short term, take the OD facility and use that money.
Okay. Nikhil, then I wanted to understand as to when you compare these two in terms of cost. First one where, loan against securities is being taken, so interest cost for that versus the opportunity cost of exiting the existing investment, right? How do you compare these two?
Okay, so say today loan against securities is available in the range of 9% to 10%. That's a broad cost of taking the loan against securities. Now, if your money is invested for very, very long-term assets, like an equities, in equity fund or equity stocks, right? And over a long period of time, what we have realized that the equity mutual funds has given you return in the range of 12 to 14% year on year, right? As compared to what the cost you are paying is only 9 to 10%. So that's and we have always realized that if you miss best days in the market, right, then returns can come down dramatically. So you can't time the market, right? So that's why it says that if you're investing this for long term in equity mutual funds and you have to bridge funding in between, then it's advisable that to take a loan against securities, because as I discussed with you, you pay capital gain tax also, because once you withdraw and again reinvest, you pay capital gain tax also. right? So in that case, even if it's a long-term assets, then you make 12 to 14% as compared to 8, 9, 10% the interest cost that you're getting. But if your money is invested in debt securities, right, in a fixed income securities, which is yielding you say 6 to 8, 7% return, then it's not advisable that if you need money for long term or medium term, then it's not advisable that you withdraw from then you take a loan against securities. It's better that you withdraw from the asset because your return on that asset is only 6 to 7%, whereas your cost is 9 to 10%.
Nikhil, the other aspect is that what happens to loan against securities in sharp market corrections? Does it add to your stress of at the worst possible time? Because at the same time, when you're paying interest, your value of investment is also going down.
True. So again, so if you're taking against equity mutual funds, so normally you get in the range of 50% of your overall value. So, for example, if your overall portfolio value is a crore rupees, you get a OD facility up to 50 lakh rupees. Whereas in debt securities, you will get a slightly higher percentage. Now, if the market goes down and the market from say you have a portfolio value from 1 crore goes to 80 lakh rupees, then what you can withdraw is only up to 40 lakh rupees. Right. So if you have already withdrawn 50 lakh rupees, then you have to do a top up, right? You have to repay 10 lakh rupees, or in that case, they'll sell the securities worth 10 lakh rupees to bridge the margin funding. Now, during the market crashes, why loan against securities makes sense? I'm saying if you're buying, if you have to withdraw during the market crash, then you're making your paper loss into permanent loss, right? If your money is only required for very, very short term and the markets have fallen, then say it's not wise to withdraw from the market that point of time. Then it's advisable that whatever OD facilities you can get for the portfolio value, take that OD facilities and use that money for your bridge funding, and do not make your paper loss into permanent loss. And as soon as the market recover, right, then your portfolio value will again go up. Because if you've already withdrawn, if you've already done redemption, and if you're not and then market rallied, then you make your loss as a permanent loss. So if when the market has crashed, then it's advisable to take loan against securities instead of redeeming the money. In normal cases, yeah, if you have taken money for a very, very long term goal, which I discussed with you, that if your loan is for 4-5 years, then it's not advisable to take loan against securities. It's always advisable that you withdraw your investments and use that money.
Interesting, very interesting, Nikhil. Now, with regard to some behavioral aspects of somebody who's taking loan against security, right? Generally, an easy access to loan against security might encourage over leveraging against his or her portfolio, right? How does one manage all of this, considering not over leveraging their portfolio as well?
See, that's the thing. The purpose has to be very, very clear. If your purpose is to do a bridge funding, if the purpose is to maintain your working capital, right, then the loan against securities completely makes sense. But the purpose is that, okay, let me borrow at 9-10% and invest that in market, assuming that I'll make 12 to 14%, that's not right, right? Because then you're leveraging your money, and then in the times when markets are bad, right, then you get a pinch of both the sides. When the markets are falling, as well as you pay the interest cost. So, like say for example, last year a lot of people thought that it's very easy to make money in equities, right? You will always make 12 to 15% return. So if you've already invested and you have mortgaged that and you've taken loan and again reinvested in equities, right? Then it's not a wise call, right? Because you lose out on both the things. So you should not over leverage, right? You should only use loan against securities to bridge your bridge funding gap. When you get over leverage, right? When the markets are very down, when the valuations are very, very cheap, like times of COVID, when the things are really markets are really cheap. That time, if you want to leverage it, so leverage also depends on when you want to leverage it. It's still fine if you want to leverage when when the markets are very, very cheap, and you want to leverage it, and you know the risk that okay, if things goes bad, I may lose out some part of the money, but if things goes in my favor, I can make huge amount of money. So leveraging during those times still is a tactical call which someone can take it. But in the normal circumstances, one should not leverage. One should not take a loan against securities and invest back in the mutual funds or equities, because markets can be in rough phase, and that time you will get a pinch on both the sides. You have to pay the interest cost as well as your portfolio is going down. So you lose out on both the sides.
Interesting. Nikhil, the other aspect is when somebody is taking a loan against security, what are the hidden clauses that one needs to look out for in the agreement that could possibly deceive the customer?
So first is the interest cost, and what is the compounding like the interest cost frequency, whether it's a monthly or it's a quarterly or it's a annually. So because as the frequency of interest cost is also depends, it will impact the overall cost of the loan. So one is that when you look at that. Second is the amount of percentage of overdraft facility they will give on the overall portfolio, right? So some may give 40%, some may give 50%, some may give 60%. You look at that very carefully. Third thing is that when they will sell the securities, right? So at what margin level they will sell the securities. So that clause has to be very, very clear. Will they give you how much heads up time they will give you in terms of reminder that okay, there's a margin call and you have to get the you have to withdraw, you have to give the money. So that the number of days and the level at which margin call will be coming in, those one need to read very, very carefully before going and signing up the loan against security.
How important do you think is monitoring the LTV ratio once you take this loan against security?
It's very, very important because if, for example, you have used the whole money and then suddenly market falls, they will only give you 1 day's notice or few hours notice, and then they'll sell your securities immediately. And that happens when markets are falling, right? So you make your paper loss into permanent loss, and that's why a lot of people lost money, right? Because what people have done is that when the markets have fallen, right, they are not able to pay the margin money, and then their shares are sold, right? And when the shares are sold, they're sold at lowest level, right? So that's what we always say, it's a margin pressure, and that's why you're seeing a huge fall in the market. So when there's why markets suddenly fall in deep dive is all because of margin pressures. That the brokers sell the securities without looking at the price, and they just sell the securities. So that's why we want to be very, very careful. You should never allow your securities to be sold at a distress level, because then you're making it a permanent loss. So you need to monitor your LTV. If your allowed limit is only 50%, make sure that you never cross 40%, right? So that you always have the buffer of 10%. So if any market falls, your securities are not sold at a distress level.
Point to note, viewers. One last question, Nikhil, before I let you go. One golden rule that every retail investor should keep in mind before planning this entire loan against security, against their portfolio.
See, loan against security is a facility given to you so that you don't break your long-term compounding. But it should not be used for your lifestyle goals. It should not be used for your consumption, right? It should only be used as a bridge funding. So if you need money suddenly for a very, very short-term purpose, right, and you are going to get back this cash flows over a 1 month, 2 month, 3 months time frame, then you can use loan against security instead of breaking the golden rule of compounding. But if the money is required for very, very long term, right, and if it's a permanent nature, then do not take loan against securities. It's better that you withdraw the investment. And third rule, never leverage, right? Leverage will only be done in the extreme when the markets are very, very lucrative, not in the normal circumstances. So don't use loan against securities as a free loan available to you and go and buy your consumption goods like phones or a car or something. The loans are not cheap. The loans are expensive. So basically, make sure that the loan which you're taking is for productive purpose and not for unproductive purpose, and do not leverage by taking loan against securities. Again, reinvest in securities, because market falls, you get the impact on both the sides. So do not take for lifestyle goals. Do not take for leveraging. Take for actually bridge funding, and you know that your cash flow is going to come.
Absolutely, Nikhil, that makes complete sense. Thank you so much. This conversation has been very helpful to me as well as to all our NDTV Profit viewers. So thank you so much for taking out the time and speaking with us at NDTV Profit.
Thanks a lot. Thank you.
All right, viewers, with that, we're completely out of time on this edition of Your Money Matters. Stay tuned. More news and updates on the other side.